Hi, I'm Devang Shah. In this video, I will take you through the summary of the events for the month of September, the impact of that on the markets, the strategy for our portfolios, outlook for the markets, risk to the view, and opportunities for the investors. The month of September was eventful for debt markets, with the Fed setting the rate cycle in motion with a 50 basis cut. It is not only the US Fed. Interestingly, this quarter, eminent global central banks implemented a total of 28 rate cuts, the most since COVID times. The Fed dot plot further gives guidance of additional 50 basis rate cut till December 2024. A 50 basis rate cut in line with CPI data for the US led to the rally in US bond yields, which are lower now by 10 to 15 basis month on month. Fed futures continue to price in another 50 to 75 basis of cut till December 2024, and we believe that Fed would follow the macro data and can deliver another 50 basis of cut till the year end. As US bond yields are pricing in near-term cuts, we expect them to trade in a range of 3.5 to 390 in the near term. Another major event for the month has been in the news is that China will issue $284 billion of sovereign debt to help revive the economy, half of which will be in the form of free handouts to stimulate consumption. This is in addition to the surprise rate cuts and the cuts in reserve requirements announced by the central bank. Though the measures announced are of significant magnitude, it's too early to conclude their execution and the impact of that on global macros, inflation, and the commodity cycle. Back home last month, CPI data again was lower on account of base effects at 3.6%. September CPI could be a tad higher at 5% due to uptick in variable prices, but the overall inflation on Q2, as highlighted last month, would be lower than RBI expectation. Banking liquidity, specifically post the advance tax outflows, got into a deficit zone for the month, but durable liquidity continues to remain hugely surplus at 4.5 trillion, most of which is now sitting with government in the form of high balances. Indian government bond yields continued to rally by 8 to 10 basis due to fall in global bond yields and increased probability of RBI changing its policy stance in October policy. Due to higher than expected rate cut by Fed, a good monsoon, lower headline inflation in Q2, and the change in MPC members, we believe that October onwards, RBI can change its monetary policy stance. We continue to expect 50 basis of rate cuts till March 2025. We have been now maintaining a higher duration across all our funds and guiding the rally in bonds since March 2024. Though we have already witnessed a more than 40 basis of rally in yields since the beginning of the year, positive demand supply dynamics for government bonds and expected rate cuts in the near future will continue to keep the bond markets happy. And we can expect another 15 to 25 basis of rally in the next 3 to 6 months. We believe that for the near term, the best of the banking liquidity is behind us. As once the festive season starts, banking liquidity will continue to be in the deficit zone, and we might see some volatility in money market yields due to the pickup in credit growth and a higher deposit supply. Hence, our portfolios continue to have a higher bias toward government bonds, and we have started to add some 1 to 2 year short-term corporate bonds from a carry perspective, as corporate bond curve in India has got inverted, where the 1 year is trading at 775 and the 5 year corporate bonds are trading at 7.25. As India's growth remains strong, we don't expect RBI to be very aggressive in cutting rates. We expect a 50 basis of rate cuts till March 2025. We see two big risks to our long duration view. The recent measures taken by the Chinese government, as they can break the disinflation cycle and can actually lead to higher commodity prices, which in turn can impact INR and bond yields. The second bigger risk is that Fed would deliver lower than anticipated rate cuts in 2025 can lead to significant shallow bond market rally in India. Investors should continue to hold their duration across their portfolios. Incremental gains in long bonds would be with policy stance change or rate cuts. In line with our core macro view, we continue to advise short to medium term funds with tactical allocation to gilt funds to our clients. I thank you for watching this space and keep watching it for more updates on fixed income outlook.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.